Welcome to the Explainer. Look, if you're tuning in right now, it means you've officially made it to week 9 of intermediate financial accounting. Take a deep breath. I completely know this is the point in the semester where the fatigue really hits, right? The accounting jargon is just blurring together on the page, but don't stress because today we are doing a high-yield study session. We're going to cut straight through the noise and decode the absolute essentials of AASB 101, which is literally the ultimate rulebook for presenting financial statements.
Here's our roadmap for today's testable material. First, surviving Week 9 accounting. 2, the ultimate financial blueprint. 3, AASB 101's 8 golden rules. 4, conquering financial position. And finally, decoding profit and loss.
All right, Section 1, Surviving Week 9 Accounting.
So, Week 9 is notoriously tough. You're juggling assignments, finals are looming, and suddenly the standards get incredibly specific. So for the next few minutes, we're focusing purely on what actually matters for your exams. No fluff, just the core concepts your professors are desperately looking for in your answers. Week 9 is completely anchored around one major topic, the presentation of financial statements. The prescribed standard you absolutely need to know is AASB 101 or IS1 if you're looking internationally. Now, this standard doesn't tell you how to calculate specific numbers. Nope. It governs exactly how those numbers must be presented to the outside world. It's basically the master formatting guide for every single public company.
Moving on to Section 2, the ultimate financial blueprint.
Let's look at how this builds our baseline understanding. We're talking about the ultimate financial blueprint, a complete set of financial statements. According to paragraph 10 of AASB 101, a complete set includes exactly these components. You've got the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, the notes, and comparative information. Guys, your professors expect you to know this list by heart. If an exam asks what constitutes a complete set, do not forget the notes and the comparative info. Students drop easy marks there all the time, and we're not going to let that be you.
Section 3, AASB 101's 8 golden rules.
Okay, we have our blueprint. Now we need the rules that govern how we actually put it together. These are absolute non-negotiables for faithful presentation, and they are incredibly frequent targets for multiple choice questions. Here are the 8 general principles: fair presentation and compliance, going concern, accrual basis, materiality and aggregation, offsetting, frequency of reporting, comparative information, and consistency of presentation. Now, don't just memorize these to list them off. You have to understand why they exist. They're there to ensure financial statements faithfully present an entity's financial position and performance in a way that aligns perfectly with the conceptual framework. Let's dig into a massive exam trap, the concept of going concern. The default assumption in accounting is that a business will just, keep on running. Financial statements are prepared on this basis unless management actually intends to liquidate the entity or cease trading. But here's the absolute kicker for your exams. If management is aware of material uncertainties that cast doubt on their ability to continue, they must explicitly disclose those uncertainties. And what if the statements aren't prepared on a going concern basis at all? Well, they have to disclose that fact, the alternate basis they used, and exactly why they are no longer a going concern.
That brilliantly leads us to our second major trap, offsetting. Paragraph 32 explicitly says that assets and liabilities and income and expenses must not be offset unless permitted by a specific standard. Why? Well, think about it from a user's perspective. Aggregating these items hides crucial data. It leads to a fundamental loss of information. If you have $1 million asset and $1 million liability, you can't just mash them together and report zero. There's no way. Users need to see the actual scale of your operations and the real risks involved.
Section 4, conquering financial position.
Let's transition into one of the heaviest sections of the standard, and honestly, a place where a lot of essay marks are won or lost. The Statement of Financial Position, aka the balance sheet. At its core, it summarizes the entity's assets, liabilities, and equity. But why do we care? For your exams, remember that it provides the basic info for evaluating a company's capital structure. It lets users analyze liquidity, solvency, financial flexibility, and gives the baseline data needed to calculate rates of return. It's essentially a snapshot of financial health.
Now, paragraph 60 generally requires assets and liabilities to be classified as current or non-current, but you really have to watch out for the exceptions here. A current asset is usually something realized within 12 months, right? However, current assets can also include inventories or receivables expected to be realized as part of the normal operating cycle, even if that cycle takes longer than 12 months. That operating cycle exception trips up students all the time. On the flip side, liability classification is based solely on conditions existing at the end of the reporting period. Don't let a practice question trick you with events that happen after the reporting date when you're trying to figure out if a liability is current.
So, I want to pose a question to you. If the statement of financial position must mathematically balance, does that mean it's a perfect, flawless reflection of an entity's true economic value? This is exactly the kind of critical thinking pivot professors absolutely love to test in long-form answers. Rote memorization gets you the baseline marks, sure, but understanding the limitations, that gets you the distinction. The answer to that question is a resounding no. One of the biggest limitations of the statement of financial position is financial engineering. Companies frequently structure deals in highly complex ways that lead to off-balance sheet rights and obligations. So the numbers you're seeing, they might not represent the total risk the company is actually exposed to out in the real world. You really need to keep a critical eye out for this when you're analyzing case studies. Beyond financial engineering, there are other severe limitations you have to be ready to discuss. First, the optional measurement of certain assets at historical cost rather than current fair value. This means the balance sheet might be wildly outdated. Second, and absolutely make sure you name-drop this standard in your exam, is the mandatory omission of internally generated intangible assets under AASB 138. Think about a tech company's internal software, or their brand value. It might be worth billions, but it's completely missing from the balance sheet. Finally, you're aggregating amounts that are measured inconsistently. Some are at historical cost, some at fair value. It's literally like adding apples and oranges.
Section 5. Decoding profit and loss.
All right, we're in the home stretch now. While the balance sheet is a snapshot, the P&L is the prime source of info for predicting an entity's future performance and future cash flows over time. The real skill here is identifying recurring versus non-recurring items. For instance, if a company makes a massive profit selling off its headquarters, well, that's non-recurring. You definitely can't use that one-off event to predict next year's operational cash flows.
Now, distinguishing regular profit or loss from other comprehensive income, or OCI, is a classic exam hurdle. I highly recommend you just take a screenshot of this mapping right now. The standard makes a strict distinction between regular P&L and OCI. The items going to OCI are super specific and dictated by other standards. For example, the effective portion of cash flow hedges, that goes to OCI under AASB 9. Changes in the revaluation surplus fall under AASB 116 or 138. Foreign currency translation gains or losses are AASB 121, and remeasurements of defined benefit plans go to OCI under AASB 119. Memorize this mapping. I promise it will save you when you have to untangle a messy trial balance.
Just like the balance sheet, the P&L has its own specific disclosures and limitations. Under paragraph 97, if an item of income or expense is material, its nature and amount must be separately disclosed so users can actually assess sustainability. But it's the limitations that really matter for your analysis. Remember how we just said internally generated intangibles are omitted from the balance sheet? Well, all that expenditure has to be mandatorily expensed on the P&L. That can make highly innovative companies look extremely unprofitable in the short term. Furthermore, the P&L is super susceptible to earnings management through biased measurement judgments by management.
Which brings us to a final, somewhat provocative thought. As you prepare for your Week 9 exams and stare down these financial statements, ask yourself, how much of what you are looking at is an objective, undeniable measurement, and how much is actually just a biased judgment wrapped up in an accounting standard? Keep that critical mindset as you tackle your practice questions this week. You've got this, good luck studying, and we'll see you in the next explainer.